Welcome to Fear and Greed, the week ahead. I'm Sean Aylmer, and as always, I'm joined by economist Stephen Koukoulas. You'll find him at thekouk.com, Thekouk, thekouk.com, and on X using the handle thekouk. Stephen, good morning.
Oh, good morning, Sean. And after last week with that battering bond market move, let's hope this gets a little calmer.
Yeah, so let's just talk about that. Inflation figures in the US came out a little hotter than expected. Not ferociously hotter, but certainly they were higher, particularly core inflation was higher than expected, 3.8% for the 12 months to the end of March. What a reaction.
And what a reaction too. Yeah, on the day, I think we had effectively a 20 basis point jump in the short end of the US yield curve, a repricing of rate cuts. And, it's sort of interesting when we look back to the start of the year in the US, there were basically, 5 or 6 rate cuts priced in. Now it's about 2, give or take. And that changed, that 100 basis point change in where the markets are expecting the Fed funds rate in the US to be at the end of this year is dramatic. And as you said, that inflation number, it was one of these funny ones. The market desperately wanted it to be a lower and a lower print to come in, core and even headline inflation lower. The fact that it was a little bit higher, it was only 1/10 higher than expectations, caused this complete reassessment of where the economy's at, whether inflation is going to get anywhere near the Fed's target anytime soon. And I think it just sort of compounded what we're seeing in commodities markets too. The other really interesting factor for me is that, the commodities markets are very, very strong. Oil, $90 a barrel approximately. Gold at record highs, $2,380 an ounce. But you look at copper, you look at lumber, you look at all these other food, wheat prices, these sort of things. They're all booming. And they're all a leading indicator of inflation. So that reassessment of last week on the inflation and therefore the interest rate outlook was huge.
And of course, people kind of tend to forget. I mean, I'm sure professional investors never forget this. This is their bread and butter. But a lot of us forget when you have bond yield moves like last week, that kind of sets the risk-free rate. So if you want to invest in something else a little riskier, such as equities or beyond, you actually need a higher return.
Indeed, and that's the curious thing about how the bond market interplays, I suppose, with the equity market and a whole lot of other financial markets too, because we know effectively that a 10-year US government bond or an Australian 10-year bond, they're basically risk-free returns. And if you're getting, say, 2% or 1%, which you were getting a few years ago, investors think, oh, gee, that's a pretty low return. I'm going to look for something that's a bit more risky to sort of zap up my return or my potential return. But when yields start getting to 4, 4.25%, 4.5%, where the US 10-year Treasury is now, then all of a sudden people think, oh, look, 4.5%, I'm an insurance company or a fund manager looking after pensions. That's not a bad return. So therefore, I'll downsize my shareholdings, stock market comes down, and that asset reallocation, I suppose, was sort of winding. And that's what we saw through the bulk of last week.
Okay, this week, labour force, that's the big number this week.
Oh, do you know what? I don't know what to say. I can speak under wet concrete normally. Last month, we had the plus 116,000 jobs and the unemployment rate going from 4.1 to 3.7%. And that, again, that had a big impact on the Australian market and expectations on where the economy is going too. But when we've looked at this number, people are sort of skeptical whether it's a real number. So we're going to be watching very closely whether it was a quirk. The statistician, like all of us, they occasionally come up with a number that they have to publish because it's what the surveys are telling them, but it turns out to be a bit of a rogue. Their sample size might have included a lot of people who had a job as opposed to just a normal sample. So that's a roundabout way of saying the market's looking for a fall, a pullback from that plus 116,000 jobs, minus 40, minus 50,000. So you look at the 2-month average, averaging about 30,000 jobs per month. And for that unemployment rate to trend back up to the high 3s, maybe even touching 4% again. But, the jury's out on, just how strong our Australian labour market is. I just would say one other thing. It's probably weaker than those labour force numbers suggest because we know that job vacancies are falling. They're down. And they're all down. And so the odd one out, if you look at the sort of the old Sesame Street, one of these things is not like the other. Well, the thing that's not the same is the ABS labour force numbers because the SEEK job ads, they're all turning down.
Yeah. Okay. Of course, that's the main piece of information this week, but massive week in a week's time. Next Monday, we get the monthly CPI figures.
Yeah, well, next week on the 24th, the day before Anzac Day, the Bureau of Stats released, but they're both the monthly figure for March, but also the March quarter, which is the comprehensive measurement of the consumer price index and inflation. I haven't seen a whole lot of forecasts yet. I think they'll come out during this week. The banks will sort of do their modelling and whatnot to see what that number might be. But I think it's fair to say from what we know from the January and February monthly numbers, it's going to be an okay result. Quarter on quarter, probably about 0.7, but we'll preview that next week. But, again, like we've seen in the US where the inflation rate's disappointed about how quickly it's falling, all eyes will be on next week when we look at our March quarter CPI to see whether inflation is actually coming down as the RBA hopes, or whether there's just a little bit of a bit of a spinning the tires in the sand and we're not quite getting that inflation rate lower quickly enough.
It's that last mile effect, isn't it?
It is, yes. It was very easy to get inflation down from 8 to 4. That was fine. No dramas. Getting it from 4 to 3.5, probably okay. Getting it from 3.5 to 2.5, and again, I don't mean to go back to the Fed, but they're a really good example. They had it easy getting it back to sort of 4 and 3.5, but they haven't been able to get it to 2%, which of course is their target, and that's why markets are sort of skittish right now. They're just unsure whether the Fed, is going to cut rates at all. And I've seen a few people come out saying, the next, Larry Summers, the next move in rates might be up in the US. Now, that would be huge if that's the case.
Stephen, enjoy your week.
I will, Sean. I will for sure.
That was economist Stephen Koukoulas, better known as The Kook. You can find him at thekook.com and follow him on X using the handle The Kook. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.